Hey guys, it's Julie here with TipRanks. In today's video, we're taking a look at two strong buy energy stocks that also come with an over 7% dividend yield. So let's get into it. Alright guys, welcome back and thank you all so much for being here. As I said, today we're taking a look at two stocks that are in the energy sector and also come in with strong buy ratings from analysts. On top of this, they also pay an over 7% dividend yield. So in today's video, we're going to take a look at what it is these companies do and what has analysts feeling so bullish on their future. Just before we get into all of that, this is your friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Okay, let's dive into these dividend paying energy companies. The first company on our list today is Kimbell Royalty Partners. Trading under the ticker KRP, they're currently priced at $12.64 per share. They pay a quarterly dividend of 31 cents per share, working out to a dividend yield of 7.41%. Now, their most recent payment came out in August, so we'll be expecting the next one here in a couple months. Now, this company combines both real estate and energy investing, as Kimbell invests in land. Specifically, the mineral extraction rights on land acres in known petrochemical producing basins. The company's portfolio holds over 13 million acres across 28 different states. This includes properties in all of the major onshore oil and gas basins in the U.S. Kimbell boasts over 97,000 wells, with its largest presence in the Texas Permian Basin. They currently have 49 active rigs drilling on their acreage and royalty interest in those over 97,000 gross wells across the U.S., which is approximately 11.8% of the entire U.S. lower 48 active drilling fleet. And approximately 98% of all onshore rigs in the lower 48 are in counties where Kimbell holds mineral interest positions. Now, Kimbell certainly had some setbacks during the pandemic, but in 2021, they saw some of their deep losses turn into small gains. From their Q4 2020 to first quarter of 2021, their earnings per share loss shrank from $1.66 to a mere 2 cents. And in the second quarter, the company reported a modest 4-cent earning per share gain. At the top line, their Q2 revenues from oil, gas, and natural gas liquids came in at $39 million, the highest in over 2 years. During 2020, management did have to cut back on their dividend payments, but rising revenues and earnings have supported a return to strong dividend payments. Since the second quarter of last year, Kimbell has raised the dividend 3 times, and in their most recent quarterly earnings report, management stated that they now expect that Kimbell will pay no material amount of federal income taxes from 2021 through 2027, and substantially all distributions paid to common unit holders from 2021 to 2025 will be free of dividend income taxes and instead be considered a return of capital. Weighing in on this most recent earnings report is John Freeman from Raymond James. Looking at their recent dividend declaration, he said that we expect this ratio to remain constant through the second half of 2021, with the third and fourth quarter projected distributions of 27 to 28 cents per share respectively. This amounts to a full year 2021 dividend of $1.13 per share, equating to about an 11% dividend yield. Keep in mind that this dividend is tax-free. Hard to imagine that there are many opportunities any better than scooping up shares in an 11% tax-free yield. John is one of 4 analysts that has a current rating on the Kimbell stock. And with 4 unanimous buy ratings, the average price target of $16.50 would be an upside potential of over 30% for this next year. Now, the lowest price target is from a few months ago with a 10% upside, and the highest is John's rating with a $20 price target, which would be a growth potential of 58%. The second energy company on our list today is HESM Partners. They trade under the ticker HESM and are currently priced just above $25 per share. Their company pays a quarterly dividend of 50 cents per share, which works out to a current dividend yield of 7.13%. Their most recent payment was on August 12th, so once again, we'll be expecting the next one here in a couple months. Hess Midstream, as the name suggests, lives in the midstream sector of the energy industry. moving oil, natural gas liquids, and refined petroleum products from wellheads and refineries to storage facilities, transport terminals, and end users. HES has a range of assets covering gathering, processing and storage, and terminaling and export based in the rich Bakken Formation of North Dakota. They have a focused and disciplined capital allocation. They completed a major infrastructure build-out program in 2020, and for 2021, they expect their capital to be significantly below that. In 2021, they're focusing on targeted gas compression capacity additions, gathering well connects, and system optimization. At the end of July, HES announced that they were increasing their quarterly dividend. They reported a distributable cash flow in the second quarter of $207.5 million. This represented that 50 cents per share dividend, which was an 11% increase. They also announced an agreement to repurchase $750 million of Class B units from different affiliates. HES has been regularly increasing their dividend over the past few years despite the pandemic. They also recently shared their second quarter earnings report. And they reported gains in the second quarter of this year with $162 million in net income compared to the $107.8 million in the year-ago quarter. Per share, their income came to 44 cents, which was up 51% from their second quarter last year. Turning to the top line, HES reported $294 million in total revenue. This was about 9% above the prior year's second quarter and the highest result in the last 2 years. Weighing in on the stock following this report was analyst Alonzo from Scotiabank. They said that this year we've continued to see outperformance in HES's operational results as gas capture has outpaced expectations. HES hits the right note on return of capital while optimizing and continuing to delever the balance sheet and maintains the financial flexibility to return additional capital. Increased activity in the Bakken with HES's third rig also sets up for continued long-term growth. And there are currently 5 analysts that have ratings on the HES stock. It comes in as a strong buy with an average price target of $28.60. This would be about a 13% average upside for the next year. We do have a hold from a couple months ago that would be a slight downside, and on the high end we have a $31 price target that would be a growth potential of 23%. So there are 2 energy companies, both coming in with strong buys and some pretty healthy dividends. Now, I always love hearing from you guys, so make sure to leave your thoughts in the comments down below on what you think of these 2 companies. Please keep in mind that these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes. Make sure you always do your own due diligence before making any investment decision. If you made it to the end of today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Thank you guys so much for watching, and I'll see you back here next time.